If you're a real estate investor or you own rental properties, you have to know what this tax form is, and that is Schedule E. Schedule E is the supplemental income or loss form where you're going to report the income and expenses that rental property makes so that ultimately you know if you have to pay tax on it or not. But as you know, if you're a real estate investor, our whole goal here is to lose money on paper to then net against your W-2 or business income to bring down your tax bill. And so part of that is making sure that all of your activity for these rental properties that you own is accurately reported. So I'm gonna walk you through this form, showing you what to look for and helping you understand the different sections of it. My name is Matt Bontrager and I'm a CPA that specializes in real estate taxation. I started my career as a tax preparer, simply preparing tax returns because that's ultimately what people need. But then as I saw clients paying too much in tax, there is a tax strategy component to helping your clients proactively bring down their tax bill. And now that's where I focus my time. I have a firm called TrueBooks with about 25 people, and that is our main goal, to help people bring down their tax bill through tax strategy. And real estate is specifically our main area of focus. And with that, let's get into how to read your own Schedule E, or in the event that you even have to fill out your own, you'll learn a little bit more through this process. All right, so let's dive into the actual Schedule E. When you look at the top, the first thing it's going to ask you is just your name. And then if you look to the top right, it's going to ask you for what your social security number is. Keep in mind that this form specifically is a part of your personal tax return. A lot of people forget that your tax return is different per person and there's different pages for different things. So just consider this as a separate page for my real estate investors out there. And if you do have any real estate investments, such as rental properties, this is where it's going to be reported. And it is just going to be a separate page included in your personal tax return. Then we come to part 1, which is income from rental real estate or royalties. This is where the actual reporting starts to happen. Let's start with questions A and B. You'll see that A is flat out asking you, did you make any payments that would require a 1099 to be issued? We'll probably have to make another video on 1099s alone, but you'll see here that it is purely asking you if any payments you made to run these rental properties or manage these royalties, for that example, did you require to cut any 1099s? So they're almost flat out asking you to tell on yourself if you were supposed to but didn't. Because look at question B. If you marked A, yes, it's asking you, did you or are you going to actually file these 1099s? There can be pretty substantial penalties for not filing 1099s. So my advice there is get with your tax professional. These are very easy to file. Each firm is filing hundreds of them. Just remember that they have to be filed by January 31st for the previous year. And you'll see simple A and B. Those are simple yes, no checkboxes. That's about it and all we have to do for that section there. So keep in mind when it comes to working with your tax preparer, all they're going to ask you is, should we check these yes? Should we check these no? Obviously, if they prepared the 1099s for you, they're going to know what that answer is. Then we come down to section 1A, which is asking you for the physical address. Notice how this is giving it to you in an ABC format. That's because throughout this entire form, you'll see that it's labeled ABC in different sections because you can put 3 properties on one page. Well, what happens if I have 5 rental properties? You would simply fill out 2 pages, A, B, and C of one page, and then A and B of another. 1A is pretty simple, and that's all we're looking for is just simply an address. This is where we get to some of the juicier stuff. So if you look at section 1B, now it's asking you for the type of property, and there's a few different types here. We have single-family residence, multifamily residence, such as an apartment building or something like that, or a duplex. Then we have vacation or short-term rentals. We have commercial buildings, land, royalties, which is no type of actual building, obviously, a self-rental, or we even have an other box where you'd have to give a short description of what it is. Most of the time, clients are choosing number 1, number 2, number 3, or 4. Specifically for the clients that we work with. Then if you move over to section 2, you'll see that it's asking you for the fair rental days, the personal use days, and if these projects or properties are QJVs, qualified joint ventures. Let's start with the fair rental days. Fair rental days is simply the amount of days within that calendar year that the property was rented at a fair market value. So you can see that if you were hooking up maybe a family member and letting them stay there for $10 a night, you would not count that as an actual fair rental day. Then we move over to personal use days. It's very important that we know what days were used as personal use because, for example, out of a 365-day year, if half of those days were used for personal use and half were fair rental days, we would not be entitled to 100% deductions for something like mortgage interest because we didn't use the property 100% of the time for business use. Part of it was used for personal. QJV or qualified joint venture is simply letting the IRS know if you check that box that you've owned that property with someone else, and they are going to report their portion on their own Schedule E on their own personal tax return. Now we get to the good stuff. We are down in the main section where we have to report the income and the expenses related to these specific properties. This is where the magic happens, and this is where your biggest task comes into play. Unless you hire a bookkeeper or your accountant does your books for you, it is your responsibility to keep track of what income and expenses you have per property. I'll put a link in the description for a template that we use and give our own clients. Feel free to use it. Keep in mind when we're talking about rents received, as it's asking here on line 3, you want to make sure that you're reporting the gross amount of rents. So for example, if you have a property manager and they charge the tenant $2,000 a month, but at the end of the day, you only see $1,800 of it, you would not put $1,800 here on this line. You would report the entire amount of $2,000, but then don't worry because later on, you would write off that $200 that you're not receiving. Say that's the property management fee. You would take that as an expense later on this form, but you want to report the gross rents received. Then we come down to the expense section. If you use the template that we use and give our clients, we have mirrored that template to be exactly set up just like this form so that it's easier for us come tax time to input this information. But you'll see categories like advertising, auto and travel, cleaning and maintenance, commissions, insurance, legal and other professional fees, management fees, mortgage interest paid to banks, other interests such as hard money, repairs, supplies, taxes, utilities, depreciation. This is, remember, the biggest expense here that we are going to utilize from a tax strategy perspective. We will do a completely separate video on depreciation for itself. Then you have other, where you would make a list so you can give them your own categories if you maybe have expenses that fall outside of these generic ones. Hint, hint, one of them is HOA fees. Very common for people to pay HOA fees, but there's no line item for it, so you would list it as another expense. Then you'll see line 20 is simply totaling up those expenses to bring you to the total expense so that we can find out what the net income is for this property, which would be reported on line 21. So think of 21 as our net income number. Now, to get a little bit nerdy, take a look at line 22. This is asking for the deductible portion of the rental real estate loss after limitations. This is where tax strategy comes into play because our whole goal here is again, to lose money on paper with our rental real estate, which we'll make another video on that because most of the time it's through depreciation. And so we want to be able to take that entire loss. So in a perfect world, if line 21 says negative 10,000, line 22 says negative 10,000 as well, meaning that you're able to take that loss against other income. You'll see line 23, A through E, is really just summarizing other lines above it, so I won't spend too much time there. 24, again, just simply summarizing the income. 25, summarizing the losses, your allowable losses, back up on line 22. 26 is simply bringing a final component to this tax form, summarizing all of the properties as one and determining what your total income or loss is. Remember, always the goal is to show losses here if we can. If that concept of showing losses on an actual tax return seems foreign to you, that's okay. It should, because our whole goal at the end of the day is for you, if you own rental properties, you want to cash flow, you want somebody paying down your mortgage, you want the value of that property to grow over time, the appreciation of it, but on paper, we want you to lose money, so therefore you're not paying taxes on the cash flow that you generate from this property, and even more so, you're utilizing these losses to bring down other income. For example, if you make $60,000 as a W-2 employee, but your rental property lost $10,000 on paper, you would be able to bring down that $60,000 W-2 with that $10,000 loss and only pay tax on 50 grand. So what does that mean for you at the end of the year? A much larger refund. Remember, at the end of the day, your tax professional is going to prepare these forms for you. So why make a video on how to review this form? It's important as a taxpayer that has rental real estate, you understand how things are being reported, because at the end of the day, the burden of proof lies with the taxpayer. So at the end of the day, even if your preparer is filling out these forms for you, if anything comes under scrutiny and the IRS is questioning anything, you have to have the backup documentation to support the numbers that are on this tax form. Your tax preparer should definitely definitely be able to help you in the event that that comes up, but you want to make sure that you're on the same page and know what's being reported on your tax return. Now, I know I just threw a ton of information at you, and most of the time you shouldn't even have to worry about doing this on your own because your tax advisor will be doing this for you. But the benefit here is just knowing that when you give your own tax return a self-review, you're able to catch things that look drastically off so that you can tip off your advisor to go back and make any updates if necessary. Now remember, we're going to do a whole video on depreciation itself because for my real estate investors, that is going to be that key component to really help bring down your tax bill, tax strategy wise. So make sure you subscribe to the channel so that you catch that video when it drops. And as always, if there's any other tax form or tax topic that you want some clarity on or want me to get on here and ramble about, please drop it in the comments so that we can make a video on it. Until next time, I appreciate you for watching.